money management by many successful traders around the world. Now, this well-known rule basically states that even if trading conditions are 100% correct or perfect, don't risk too much on a single trade. Now, you will usually see, say, poker players, when they have a really good hand, go all in because they're certain that their hand is the strongest. That rule does not apply to Forex trading because there are always factors outside of our control that can turn prices against us and basically take out our stop loss. So the point of the 2% rule is that even if the conditions are 100% perfect, always ensure that you know what the worst case scenario is. So the 2% rule basically applies to the risk part of your trade, i.e. the amount of pips that you're using for your stop loss. So if you're using 10 pips for your stop loss, you must ensure that the amount of money you assign to those 10 pips is no more than 2% of your total investment per day. So you're basically setting yourself a 2% loss per day. And once you hit that loss, if you got taken out by number of factors, then that's where you stop. So let's say that you've got $1,000 in your trading account. Now 2% of 1,000 is $50. So $50 is the maximum that you're allowing yourself to lose per day. So if you're trading or using a 10 pip stop loss, the max that you should invest is $5 per pip. And the reason for that is because $5 times 10 pips, which is your stop loss, equals $50, which is your maximum loss per day, which of course equates to 2% of your total investment. So let's have a look at that example on the chart. So the area that we're looking at is here. So let's say that we wanted to enter here and our target was here. So what we have is just a line to define that. So we've got our entry and our target. So entry is here, our target is here, which is equivalent to this previous high. Now, if we're playing or using a 10p stop loss, let's say that for the sake of the argument, the gap between the top line and the bottom line is 10 pips. We must ensure that those 10 pips are no more than $50, which of course, like we said, was equivalent to 2% of our total investment. If we get stopped out, that's our limit for the day. If we continue and reach that target like we did here, then we'll have a new 2% figure because our total investment will be our winnings plus the 1,000 that we already had. Now, to spread out the risk, you can apply the 2% rule to 2 or 3 trades rather than just one. So this way you are guaranteed to have 3 goes at generating profit, but your investment will be lower as that 2% risk has to be divided into 3 portions. So after you have your results from all 3 trades, you can apply the 2% rule to the new total investment amount that you have. Risk-reward ratio, because this is something that every trader needs to include within their money management techniques. Now, you may know or have heard of traders who generate more winning trades than losing trades, but still lose money. So their wins tend to be constant and frequent and are usually the same amount in every single trade. But then a single loss takes out either 2 or 3 of their winners, and in the end they end up in a losing position for the day. Now, one of the reasons for this could be that the risk-reward ratio is not correct. So what is risk-reward? In terms of its definition, the risk is obviously the amount of money you're willing to risk within a trade, and the reward is the potential profit target that you're aiming to get. So in terms of the ratio between the two, what is recommended? Well, professional traders recommend a risk-reward ratio of 1 to 3. So this means that your reward is 3 times the amount of that risk. So basically, if you lose once, you still have another 2 trades worth of winnings to rely on. In reality, a good risk-reward ratio to use is 1 to 2. So your reward is double of the risk that you're willing to put up in the market. So in terms of our calculation, the only thing that we need to do is divide the reward by the risk to see what ratio is relative to our trade. So let's say, for the sake of the argument, that our reward or our potential profit target will provide for us $100. The risk that we're putting up is $50. So if you divide 100 by 50, the answer is 2. So our risk reward ratio is 1 to 2. So that means that our reward is double compared to the risk that we're looking to put up in the market. So let's look at a risk reward ratio example in our chart. So the area that we're looking at is here. Okay, so what we're looking for is an entry just a few pips above this high here, and our profit target is somewhere that's relative to this previous high. So let's just define those by a horizontal line. So we got our entry here, which has been hit by this candle, and our profit target is just a few pips below the previous high, which is here, which has obviously been hit by this long white candle. Now our risk or our stop loss is going to be just a few pips below this low here. So we're going to take a horizontal line again and just put it a few pips below that previous low. Now you can see with the naked eye that our reward, which is this area here, is almost double the size, if not double the size of our risk area, which is here. So we have two areas, the reward area and the risk area. So in terms of our calculations, let's say that our profit target would generate $100 when it reaches this profit line here. And unfortunately, if our stop loss is hit, we would lose $50, and our stop loss line is here. Now, if we do this on every single trade, all we need is one win out of two to basically be in a profit-making position.